Good morning. We've got new information from the most recent CPI print, as well as an update on home buyer demand and mortgage interest rates. So let's jump into the specifics and get to the bottom line. Good morning. It is hard to believe, but we are already entering the third week of January, which means that the first month of 2023 is officially halfway over. So, as always, we want to get started this week by digging into the staples and taking a look at application volume, aka home buyer demand, and interest rates, aka affordability. So, without further ado, purchase application volume came in at negative 0.5%. So, that's a negative half of a percent. Basically flat, but it is worth noting that this is the third consecutive week of purchase application decline. So that's definitely noteworthy. From an interest rate perspective, we saw that the conventional conforming mortgage rate declined from 6.58% down to 6.42%. So really just recovering some of the losses that we had lost the week prior. But overall, things are looking good. Rates are continuing to improve, and we're seeing the trend more favorably towards rates as the CPI reports continue to come in. Speaking of CPI, which is commonly referred to as inflation, Justin, why don't you tell our viewers about the most recent CPI print that came out and how this is affecting the market?
Thanks, Jake. I'm happy to be here. I have some interesting information to provide regarding the CPI report. The consumer price gains are continuing to cool. The consumer price index decreased from 7.1% to 6.5%. This is great to see as annual inflation rate was the slowest since October 2021. As a reminder to anyone listening, the Fed has a target of a 2% inflation. You can see how we have a little ways to go here, but as an interesting perspective, if you took the last three CPI prints and extrapolate over the next 12 months, the run rate would be 1.6%, which would actually meet the Fed's goal. The takeaway is that inflation is moderating meaningfully, but the key question now is how quickly and how completely it will be to return to normal after a year and a half of this unusual rapid increase. We are showing promise, and hopefully there's more to come this year. Back to you, Jake.
All right, thanks, Justin. That is really great information. And what goes hand in hand with cooling inflation and everything that we're talking about here today actually is part of the CPI report, and that makes up 39% of core CPI. And this component is shelter costs. And so we should dig into that, right? And we're seeing the cost of rent continuing to increase, although it is increasing by a very small margin. Most recently, last month, rents were reported up 0.8%, so just under 1% month over month, posting 8.3% gains year over year. However, we're starting to see this metric come down, especially the metric of the increase of cost to rent. Now, rent is definitely going to be up from last year. There's no doubt about that. But we're talking about when it comes to inflation, the increases to that cost moving forward. So that component is what's starting to cool down. And when it does, the inflationary pressure that almost half of this report is being made up from is actually going to reverse. So when rents start to be deflationary, it's actually going to move CPI in a really big way because 39% of core CPI is from these shelter costs. And we don't think that this has really been put into the markets just yet. We actually think that projecting moving forward, it's probably going to be around February before we start to see the flip on the shelter cost being deflationary. And as all of these indicators are lagging, if we get that information in February, that'll start to hit the reports in March, and so start to affect the markets as of March, April, May, really setting us up for an awesome spring market. Let's hope. Anyways, we appreciate you tuning in to the bottom line each week, and we'll continue to bring you the most recent up-to-date information from the market and the Fed so that you are best equipped each week to deal with the challenges of the market as they continue to present themselves. Please keep tuning in here each week for more on the bottom line.